in early January 2026 as dawn broke over Wall Street. Traders stared at their screens and felt a strange tension in the air. The US dollar was sliding lower, yet stocks were climbing higher. And this unusual dance signaled that something powerful was moving beneath the surface. In New York, veteran investor Mark Collins remembered the chaos of 2008 and whispered that this felt like the start of another historic chapter. Just hours earlier, the Federal Reserve, led by Jerome Powell, had hinted that interest rate cuts could arrive sooner than expected, shaking global currency markets. The dollar index slipped, and within minutes, the S&P 500 surged, powered by heavy buying in technology, energy, and defense stocks. At Apple headquarters in Cupertino, executives watched their share price jump as global investors rushed back into American equities. Across the country, in Austin, Tesla engineers celebrated quietly as their stocks soared on hopes of cheaper borrowing and renewed consumer demand. Economic advisors studied inflation charts, employment data, and debt projections, trying to forecast the consequences of a weakening currency. The story of 2026 volatility truly began years earlier. During the pandemic recovery of 2021, when massive stimulus reshaped the global financial system. In 2022 and 2023, inflation exploded, forcing the Fed to raise rates at the fastest pace in 4 decades. By 2024, cracks started to appear as households struggled, corporate profits slowed, and geopolitical tensions intensified across Europe and the Middle East. Then in 2025, artificial intelligence investment boomed, pushing markets upward even as economic fundamentals weakened. By the time 2026 arrived, investors were standing on a fragile bridge between hope and fear. The dollar weakened because traders believed lower rates were coming, reducing the return on U.S. assets compared to other currencies. At the same time, stocks rallied because cheaper money promised fresh growth, higher earnings, and easier access to capital. This contradiction created a powerful surge of volatility that rippled across global markets. In London, hedge fund manager Sarah Whitman adjusted her positions, betting against the dollar while doubling down on American tech stocks. In Tokyo, currency strategists at Nomura warned that sudden capital flows could destabilize Asian markets. In Frankfurt, officials at the European Central Bank monitored the euro's sharp rise, concerned about export competitiveness. Every major financial center felt the shockwaves. The drama intensified when Nvidia reported record profits from AI chip sales, pushing the Nasdaq to new highs. Within hours, Microsoft, Amazon, and Alphabet followed, adding billions in market value. Yet, beneath this celebration, bond markets flashed warning signs. Treasury yields swung wildly as traders debated whether inflation was truly under control. In Chicago, pension fund managers worried that extreme volatility could threaten long-term stability. In California, real estate developers feared another cycle of boom and bust. Across America, everyday families felt confused as retirement accounts rose, while grocery bills remained stubbornly high. The dollar's weakness also reshaped global trade patterns almost overnight. U.S. exports became cheaper, boosting manufacturers in Ohio, Michigan, and Texas. Imports, however, grew more expensive, squeezing retailers and consumers. In Los Angeles, port operators noticed a shift in cargo flows as shipping contracts were renegotiated. Energy markets reacted sharply, with oil prices jumping as traders anticipated higher global demand. Defense stocks rallied after new geopolitical tensions raised expectations of increased government spending. Meanwhile, gold climbed as investors sought protection against currency instability. This complex web of reactions made 2026 one of the most unpredictable years in modern financial history. Behind every price movement stood human emotion, fear of missing out, fear of loss, and hope for a better future. In Boston, young traders crowded into co-working spaces, chasing momentum plays. In Omaha, long-term investors quietly accumulated shares, trusting fundamentals over headlines. The Federal Reserve faced enormous pressure, balancing inflation control with economic growth. Every speech by Jerome Powell sent markets swinging within seconds. His data release became a dramatic event, watched by millions. As weeks passed, the volatility intensified, drawing comparisons to the dot-com boom and the post-pandemic surge. But unlike those eras, this time technology, geopolitics, and debt levels were all colliding at once. Corporate leaders struggled to plan investments amid uncertain currency trends. Small business owners delayed expansion, waiting for clearer signals. Global banks adjusted risk models daily, trying to stay ahead of rapid shifts. Even seasoned traders admitted they had never seen such complex crosscurrents. The story of 2026 was not just about charts and numbers. It was about confidence, perception, and trust in institutions. A weaker dollar questioned America's financial dominance. A roaring stock market tested the limits of optimism. Together, they formed a volatile mix that demanded caution and courage. History showed that such periods often created both extraordinary winners and devastating losers. Those who understood the deeper forces could protect their wealth. Those who ignored them risked sudden and painful losses. The key lesson was diversification, balancing risk across assets, sectors, and regions. Another lesson was patience, resisting emotional decisions driven by daily headlines. Investors also learned the importance of understanding macroeconomic trends, not just stock tips. For policymakers, the lesson was humility, because markets often move beyond human control. For businesses, the lesson was adaptability, because change had become the only constant. As summer approached, volatility remained high, yet opportunity remained alive. Capital continued to flow, innovation continued to surge, and ambition continued to drive progress. The dollar and stocks kept dancing, sometimes in harmony, sometimes in conflict. Every trading day wrote a new chapter in this unfolding financial saga. By the end of 2026, historians would debate whether this was the start of a new economic era or a warning of deeper troubles ahead. What remained certain was that millions of lives were being shaped by decisions made in boardrooms, trading floors, and central banks. In this powerful clash between currency and capital, hope and fear, stability and chaos, the world watched closely. Because in moments like these, fortunes are built, dreams are tested, and history is written. And as the dollar weakens and stocks rally, one question echoes across America and beyond. Are we witnessing the birth of a stronger future, or standing on the edge of the next great financial storm?